These macroeconomic charts will blow your mind and hopefully give you a clear picture of what is going on with the world economy and financial markets so that you can make more informed investing decisions. Let's start with the federal funds rate. This is what is driving everything right now. This comes from NorthStarBadCharts.com. The 12-month rate of change on the Fed funds rate in the lower half of the chart is faster and steeper than at any point in history. This is the fastest monetary tightening in history. And so because of that, everything is falling apart. This comes from Alessio. Small business index of better conditions is at the lowest in 48 years. It is all completely correlated. Obviously, the economy is rotting. You have this out of the Bank of England. This is their projection. UK set for almost 2 years without any growth. Again, we're looking at the global scale. You can see the bars when they're below that midline are in a recession. This is what they're projecting into the second half of 2023. And so we know the Federal Reserve is causing a recession/depression before our very eyes in order to fight inflation. And so you have the yield curve inverting. This comes from Holger Japitz at a historic inversion, meaning the 2-year yield is higher than the 10-year yield, meaning that future growth expectations are lower, far lower than what they are today. Now, the market is trying to price in recession. And so if you look at this chart, the blue is the yield curve inverting. So when it's below the line, the zero line, we're at negative. And so this is the 210 yield curve in blue. And so when that goes negative, the yield curve inverts. And on top of that blue activity, which is the yield curve spread, you can see the white, which is the US stock market, S&P 500. This is truly mind-blowing and fascinating. It comes from Tommy Thornton. You can just see that whenever, if you look back in the past, whenever the 2 and 10 yield curve spread goes negative like this, what follows is a massive crash. And so in 2000, we were deep negative for quite a while. And then we had a stomach churning crash for 3 years from 2000 down to 2002. Then in 2008, everyone knows the global financial crisis that happened after the yield curve inverted. It takes some time for this yield curve inversion to actually be reflected in financial markets. It inverted in late 2019, and right after that, again, within a few months, this stuff takes time. We had the pandemic crash in 2020, and then we had the yield curve inversion just now, absolutely historically bad yield curve inversion, and we can expect the true final crash to not take place for a few more months. There's a lag once the yield curve inverts. That is what is important. And so it takes time for this all to work through the system. The last 3 videos I put out have called for this bear market rally. We're seeing it. The market was oversold. There was fear. Well, now you're just getting your typical bear market sucker rally. That's what I've called it. But again, markets are too complicated to be black and white about it. This is what the market is thinking. Inflation has peaked. The Federal Reserve won't have to tighten and destroy the economy anymore. And so they're trying to price in ahead of time new growth and a resolution to this mess. So again, we always have to ask the questions, what is inflation going to do? And what is the Federal Reserve going to do? So here is a chart showing the tips break evens versus headline inflation. So you have yellow, which is core PCE. PCE is a measure of inflation. CPI is also a measure of inflation. You can see that normally they trace each other. The Federal Reserve looks at PCE, but you can see the forward inflation curve in black. That is what the markets are expecting. So this bull market rally full steam ahead. Inflation will come down. We've peaked. It's all great, right? Well, that is what the market is thinking. Now, if that's the case, the Federal Reserve will not have to hike interest rates as much. But let's discuss the details. So we had a very positive payroll report that came out showing 500,000 plus jobs created in the United States. Now, what that does is embolden the Fed. It says, clearly, we haven't tightened enough to cause mass systemic financial risk in markets, or we're not crashing the economy fast enough. Clearly, the economy is overheating. I just showed you charts showing that the economy is absolutely not overheating. It is rotting to the core. But this big payroll number is causing the Fed to think that there is growth. Now, payroll is a lagging indicator. Here is a chart showing right before the tech bubble in 2000 how strong payroll was, but that changed rapidly. And so, yes, we can absolutely expect that depression and recession to come ahead of us. And so this is a sign of where things are going. This comes from Tavi Costa, US job openings declining massively. This is the reality. Again, you can talk about how many jobs were created in the past, but let's look into the future. US job openings. So what's happening is the Federal Reserve is going to feel emboldened by this payroll number, saying the economy is strong. We're going to continue to fight inflation. Inflation is the enemy. And they are going to keep tightening until everything unravels. And the big concern here is that the Federal Reserve won't do enough. That is what's so sickening about this time. You have the Federal Reserve trying to combat inflation, right? They're doing their small interest rate increases. It's crashing everything. But what is scary is that they are going to have to do even more if inflation turns out to be way worse than what the economy is thinking. And so let's look around the world. What is the data telling us? In Europe, you have electricity baseload power. This chart comes from Andreas Steno-Larsen, just absolutely skyrocketing on an uptrend, and this is going nowhere. The war in Ukraine is not going anywhere anytime soon, and so Europe is going to deal with a massive energy crisis. You have this signal from Bridgewater showing leading stagflationary pressures. And so what Bridgewater Capital, which is Ray Dalio's hedge fund, is showing is that they are projecting the strongest stagflationary signal in 100 years. Stagflation is slow growth and high inflation. Again, right now the market is thinking we're going to get slow growth and low inflation. But what if we get slow growth and high inflation? That is the question. Bridgewater, Ray Dalio is expecting massive stagflation. The difference between what is likely to transpire in the near term and what is discounted is the strongest near-term stagflationary signal in 100 years. So what if the Federal Reserve has no choice but to continue to hike rates into this economic depression, which everyone knows we're heading into? Then it's really disastrous, right? Dallas Fed trimmed mean PCE, had largest 1 month annualized jump since July 1982. Look at this chart from Liz Ann Saunders showing sticky, higher inflation. This isn't going down quite yet. The market thinks it will, but again, what if it doesn't? And so what is really driving this inflation? We have this analysis from Jesse Felder. War is inflationary. Think of the economic war as a fight between the consumer-driven West, where the level of demand has been maximized, and the production-driven East, where the level of supply has been maximized. Well, now relations are souring. The U.S. is trying to shore up supply of crucial assets. And so it's going to take some time for these kinks to be worked out. This is where the stickiness of inflation comes in. So now, again, somehow we've been able to correctly predict market price action for the last few weeks. We're not trying to time the market here, but it is very interesting. This is how retail crowds are positioning. Now, normally the market does the exact opposite of what retail crowds are doing, right? The less informed, more emotional investors. And so this is how they are positioning. Net purchases among retail investors of a basket of tech stocks is extremely high, pretty much at an all-time high when you actually go back. And so the retail crowds are piling into technology because they think a lot of these problems are resolved. But are they resolved? In my own personal opinion, it seems that there's a lot of pain ahead for financial markets. Either you have a massive depression, a historic recession slash depression, and stocks crash because rates are suffocatingly high, and the Federal Reserve is going to have to lower them in order to get us out of it. And they're going to need a kick like a crashing stock market to get them to do it. Or you have stagflation, which means the Federal Reserve is going to have to continue to tightening even in a crashing stock market environment if inflation is high, because they're trying to kill inflation. So you guys tell me what you think. Last week I said we're going to have a few weeks of bear market rallies. Well, we're going to get some more inflation data coming out here soon. And if it is hot, then it is not great for financial markets. And so I think based on the positioning of the retail emotional traders, people are going to get long at the wrong time. There's probably going to be one last scare in the stock market. But again, this bear market rally frenzy could get overheated. My own personal strategy is to keep at least 1% of my portfolio in a perpetual short position, because I don't want to get rid of my high quality long assets. You don't want to miss out on that big move when it happens. And so what I like to do is just keep a portion of my portfolio in a perpetually short position so that I get to take advantage of the massive swings down potentially while not losing exposure to the highest quality assets, and eventually convert those short selling profits into purchases of high quality assets for the long term. We will stay on top of this market. You guys tell me and tell others what you think in the comments, but it is an exciting time to say the least. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky and you can lose lots of money in them.